Hey everyone, me Kevin here. In this video, we're going to talk about the most dangerous thing in the stock market right now, in my opinion. And it's a little bit different from what you've heard in the past. So yeah, this is a little bit of a change, and we're going to explain exactly why. This video, by the way, is brought to you by Truebill. Go to metkevin.com/Truebill to learn more about Truebill, or stay tuned for when we talk about Truebill in just a moment. Okay, so first, it's very important to know that we are in, and I'm sure you already know this, we are in a very euphoric style market in general. Yes, there are times, there are weeks, or there are days where we have dips, but the dips usually aren't substantial. Intraday, we had an S&P sell-off on Monday of 5%. On the day, we only fell about 3.6%. We have not had a negative 5% sell-off on a day in the S&P 500 since September of last year. It's been a year since the S&P 500 has dropped 5% or more, which is, again, on a closing day, on a closing price, which is pretty incredible. And we've also seen a lot of volatility in the market get reduced. We've seen volatility come down. This is why you could have literally bought Tesla options while Tesla was at $715. You could have bought leaps for Tesla, and they could be in the money for 2023. And even though Tesla is green and above $750 right now, you could be negative because of something known as Volatility Crush. But I've been talking about this since about May and June, that we're seeing volatility come down substantially, right? So volatility is coming down over the course of the last year. We've kind of seen the S&P 500 just go chug along straight up. Stocks like Google have done the same thing. It's been pretty incredible. And overall, stock market has been pretty good. Yeah, there's some momentum plays that have shot up only to come crashing down. This is normal. We expect this. But overall, the stock market has been very good. Every time we see dips, they get bought up very quickly. And that's because a lot of, in my opinion, the negative catalysts that we have are pretty fleeting. That is, they're pretty temporary. I mean, think about it. On Monday, I even said this, on Monday, while the market was bloody red and screaming red and Bloody Mary, I said on this channel, look, the Evergrande issue, it's going to be temporary. In the next 2 weeks, we'll know what happens with Evergrande. So yeah, maybe there would be a few more opportunities for red, but fear around Evergrande is really evaporating, mostly because you've got a lot of institutions and funds and banks coming out saying, look, this will probably be a localized issue. We're not expecting mass contagion. So the market has really relaxed over Evergrande fears. We have a path from the Federal Reserve now. We're not expecting the taper. Well, we didn't get the taper, which we did expect that. And we're now expecting the taper in November. And we expect the taper to end the middle of next year. And then we'll get a 0.25% interest rate bump in the second half of next year. Like, we've got a pretty clear path here. We also have now verbal talk that Democrats are going to figure out how to extend the budget and raise the debt ceiling, probably by doing the budget reconciliation bill as part of the $3.5 trillion bill. It'll get done over the next 3 weeks. And all these issues will be gone. Like, all these negative catalysts that we've had are going away. And we expected that. But we have also expected that inflation would at some point inflect down, and we still think that can happen when we get CPI readings for September and October. I've been saying that for like 8 months now. September and October. Kind of tired of saying it. You're probably tired of hearing about it, which is more important. But so this really leaves the door to this weird market that we're in. And I want to talk about what I think is particularly dangerous. And it takes this setup to talk about what I think is particularly dangerous. And it has to do with stocks and options, obviously. So first, what's not dangerous, in my opinion, is selling a put or buying shares. The reason I say that is buying shares is a wonderful thing. Don't worry about your cost basis, in my opinion. Somebody very well put it this morning. They said cost basis is just like the sunk cost fallacy. You can't focus on your cost basis. If you're like, oh, I want to buy more, but it'll increase my cost basis. What, you want a vanity number? Take a screenshot and then buy more. Move on, right? Cost basis doesn't matter so much. So don't worry about your cost basis. Buying shares is great in companies you love and you want to hold long term. There's some things that I think are very pricey right now. Like, I personally think Etsy is pricey. So I'm not super jumping up and down about buying more Etsy, even though I've got over $1 million in Etsy. I do think that Enphase is relatively cheap especially with its relative performance here recently. And so I've been increasing my position in Enphase, even though that increases my cost basis from when I bought a lot of shares around that 120 range, and I'm seeing my cost basis go up. I'm buying. I'm not so worried about buying shares. I like buying shares. I'll also sell puts on companies that I'd be okay to own, but don't necessarily care to own. I won't be upset if I don't own them. And I did that, for example, on SoFi. I've made a lot of money selling a lot of puts on SoFi. And that's really because I took advantage of a lot of volatility that we specifically had in SoFi stock when we saw that volatility. And as that volatility has been crushing, as a seller of option contracts, you get that volatility benefit, which makes us open up the door to, hey, well, then we should also sell calls, right? So let's break these two things down here because there's some very big differences between these two. And one of these is somewhat dangerous. But we're going to talk about that right after I talk about Truebill. Let's go to Truebill. Are you a busy person and do you want to save money? Well, consider checking out Truebill. Truebill is designed to be a finance app for busy people. Truebill lets you manage subscriptions, monitor your credit score, and build your savings all in one place. And I'll tell you, if there's one thing that drives me nuts, it's having subscriptions that I don't even realize I'm still paying for. Then I look at my credit card bill and I'm like, you gotta be kidding me. I'm still paying for this. I stopped using that 6 months ago. Well, Truebill lets you manage these things and cancel subscriptions easily. One of my favorite features of Truebill is just this. I usually call these vampire subscriptions because they just suck your bank account dry. They keep looking for more to take from you. Truebill found that the average American spends over $200 a month on subscriptions, but that average American thinks they spend closer to $80 per month. And that's partly because of those vampires. Truebill also allows you to monitor your credit score. When investing in real estate, having a good to great credit score is extremely important. So that way you get the best interest rates, especially on those 30-year fixed rate mortgages. Truebill also has savings accounts. This can be super helpful when you're trying to save up for your first property. And Truebill makes sure all of your data is secure by using the same security protocol that banks use to ensure your personal information is fully encrypted. Check out Truebill by going to metkevin.com/Truebill. That's metkevin.com/Truebill to see if Truebill is a good fit for you. metkevin.com/Truebill. Okay, folks. So there's Truebill. Go to metkevin.com/Truebill. So let's talk about what I believe is something dangerous in this market. And it's been one of the few option contracts that have really burned me. They are selling calls in a potentially euphoric or negative catalyst-less market. Catalyst-less market. As without catalyst for markets to go to the downside. And I want to be clear, just because I don't see negative catalysts doesn't mean there aren't negative catalysts or black swans or things that I can't see or can't know right now. I'm not saying that there will not be a market crash. But when we're in a position where the stock market clearly is willing to buy up any dip that there is, the stock market clearly and the economy as a whole have so much cash available that we're struggling to figure out where to put that cash. Just look at the Fed repo video that I did yesterday. It's insane. They're opening up and expanding the limits because there's so much cash that needs to be parked. I believe that there's a potential downside risk, potentially a severe downside risk, in selling call options against your stock. Now, I think it makes sense in some cases. Like, for example, I sold calls, which creates a covered call against Robinhood. And that was when it ran up to $70. It did its euphoric run. I took 99% profit on those options. That was wonderful, right? I've also recently sold some covered calls against Tesla. And those have worked really well. Just to show you kind of how this works, basically what you're doing when you sell a call is what you're saying is, hey, I'm willing to sell 100 shares of Tesla at a certain price on a certain date. And you could see that here with 4 contracts I entered into. So I said, for example, I was willing to sell Tesla at $750 November 19th, willing to sell Tesla for $800 on January 21st, right? Just an example here. And this negative here means that today the price of those contracts got cheaper. But what you'll see right here, the second to the right column here, those are my gains or losses on those contracts, those call contracts. And I don't really want to sell my Tesla shares. I don't want to lose my Tesla shares. So what I did today is I actually close these contracts by buying them back, basically. And so on these contracts, net right here, this is up about, 84 minus 4.5, so up about $80,000 on these particular contracts, where I sold calls on the shares that I own, basically entering into an agreement with somebody that I would be willing to get rid of my Tesla shares in the future for a price. And I'm closing out those contracts, meaning I don't want sold calls anymore. And that's what this video is about. This video is about me being nervous about sold calls, not wanting sold calls, because of what I think is potentially going to be coming. And that's that euphoric rally where the market just says, there is no alternative. We must own stocks. We have too much cash. The negative catalysts are gone. The dip is unlikely to come, and we may as well go into stocks. That can push our stock prices up and really exponentially kill sold call options. Now, when a call contract is sold, you could just hold that contract through the expiration, and worst case scenario, you lose your shares, right? But you still get the credit. But if you wanted to trade that contract, your call option can go negative more than 100%. Because for you to get rid of that on a stock that could just keep going up and up and up and up, you could literally have an infinite loss if you wanted to buy that contract back. Again, you could just hold it to expiration, lose your shares. But if you want to trade the contract, you could have an infinite loss because you'll see an exponential loss as the stock runs. And where I really saw this happen and where it bothered me, because I got nipped twice on this. I've made a whole lot more money on the stock, so I'm not so worried about it. Lots of money on the stock. It's been a very, very profitable trade as a firm. In total, I probably lost about $35,000 on covered call contracts. And the reason I took the loss on it is because I didn't want to lose my Affirm position. So Affirm is a stock that a few weeks ago I talked about going in heavy on, and I threw in options and shares, and I was exposed to this by about $500,000. Of course, anytime I make a buy or sell transaction, remember, I send those alerts to everybody in the Stocks and Psychology of Money group. Link down below. There are a bunch of courses on building your wealth down there. You could use that coupon code that expires on Friday. Pricing will be going up. Sure, there'll be some new coupon in the future, but the pricing does go up. So if you want to get the better pricing, lock that pricing in now. You'll never see the price go below. It always just keeps going up, kind of like Affirm stock here recently. But anyway, so Affirm has been a wonderful, wonderful investment. It's been really good. I made a very detailed public video about them as well. You could look that up. Just type into YouTube, Meet Kevin Affirm. I think the title might have been like my $1 million investment or something like that. Anyway, so I have a lot of information on Affirm in that video. And the problem I had with Affirm is when it ran the first time, I sold a covered call, or I sold a call, which is known as having a covered call. And I saw that a contract go substantially negative, like way, 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 way negative. It wasn't a very large contract, but the thing went to like negative 120% or something like that. It was really ugly. It was down like $80,000 at some point. And the contract, like the amount of money that I put on the contract wasn't even that much. Again, it was literally upside down on trading the contract. Now, fortunately, Affirm has had these sort of moments where it like runs and then it kind of comes back. So I was able to bail out of that and get out essentially with a nip rather than an epic large loss. But I didn't want to lose my shares. And that's good that I didn't lose my shares here because look at this. It ran to 126 the other day. It's sitting at 122 now. It's becoming almost like an upstart where it's just this unstoppable stock. And in my opinion, the valuation is kind of crazy on. Now, I don't think the valuation on Affirm is crazy. I think it's high, but I think Upstart's valuation is crazy. But hey, look, I can't disagree with its performance. Its performance has been phenomenal. I mean, this stock is a triple since I traded it in the summer. I did some short-term trading on it, like between around $120. And so, I mean, look, it's literally essentially a triple here. It's crazy. You know, this would have been a buy and hold or should have been a buy and hold, but I thought it was overvalued then. So I think it's overvalued now too. But that's okay. You know, that happens. So, but anyway, where I want to go with this is saying covered calls in this kind of market can be very dangerous. And so I would avoid those. This is different from what I've previously said. Remember, previously I said I like, because volatility is declining, selling contracts, selling calls, selling puts. I'm making a change. And that's because of the negative catalysts evaporating in the market. So as the market is changing, I'm changing with it. And I am no longer doing covered calls. In fact, I have closed every single sold call contract that I have. I currently own 0 covered calls. Closed them out on Tesla, closed them out on Robinhood. Net, they've been very profitable. Even though I've gotten my butt nipped on Affirm ones, net, they've been very profitable. So the only 2 option contracts that I'm willing to play in this market right now are sold puts and short-term call options. Short-term call options are more speculative, obviously. You can make a lot of money, you can lose a lot of money. One that, for example, I have a short-term call option on now is Wynn Resorts. I have a short-term call on this one. It's an October 15th call. I bought it in the money at like $80 or whatever, and it gives me a little bit of insulation. I really want to trade that one as we see recovery stocks kind of rally back, but also I want to make sure that I get out of that before we get potentially more negative, bad news from China on regulatory action. Although I think China's got their hands full right now with Evergrande. I never put it past China to do some crazy things. So that's a risky one. That's a little bit more of a trade, kind of YOLO-esque kind of style trade. I'm okay with that in this kind of market. But again, it's, when you go into trades, it's important to know, are you doing a trade to buy and hold something? Are you doing it as a short-term swing trade? You could be in and out within a day or two. Is it a YOLO? What is it, right? So just be honest with yourself about what you're doing. But yeah, look, I think selling calls right now, potentially risky. I generally, look, I would still say if you're willing to hold your contracts through to expiration, it's not that big of a deal. If you want to hold your contracts through to expiration, and you're willing to lose those shares that you have, that you're selling calls against, fine. But certainly don't do naked, which is where you don't have the underlying shares. But yeah, otherwise, very interested right now in staying away from those, either selling puts or just buying shares. And specifically of companies that are still somewhat depressed, we're probably not going to see those May prices again. And so that's okay. I realize that. I'm over that. But in terms of negative catalysts, if you know any, please let me know in the comments down below. And folks, thanks for watching this video. Hopefully this was helpful, and we'll see you in the next one. Bye.